2 days ago, the National Bank of Rwanda made a major move. They raised interest rates to 7.25%. Here is what that means for your money. On February 19th, BNR's Monetary Policy Committee met and decided to increase the central bank rate, that is the main interest rate that influences all other rates in Rwanda, from 6.75 to 7.25%. A 50 basis point increase. Think of the central bank rate as the price of money. When BNR raises it, borrowing money becomes more expensive across the entire economy. Banks pay more to borrow from BNR, so they charge you more on your loans. It is a chain reaction. BNR raised rates because inflation is getting too hot. In January, urban inflation hit 8.9%, officially exceeding BNR's target band of 2 to 8%. That triggered action. 3 things are driving prices up right now. First, higher electricity tariffs that took effect in October 2025. Your electricity bill went up, and so did costs for every business that uses power, which is all of them. Second, rising fuel prices. Charcoal supply is tight, petrol costs more, and that flows into transport and food delivery costs. Third, below normal rainfall is hurting Season A crops. Less vegetables, higher prices at the market. BNR warns this could keep food inflation elevated through the first half of 2026. If you have a variable rate loan, a mortgage, business loan, or personal loan, your monthly payment could go up. Not immediately, but within the next quarter as banks adjust their rates. The current average lending rate is 15.72%. With this rate hike, expect it to inch towards 16% or higher. On a 10 million Rwandan franc loan, even a small rate increase can mean 15,000 to 25,000 more francs per month. If you are thinking about taking a new loan, this is a signal that borrowing is getting more expensive. If you can wait, it might be worth waiting to see if rates come back down later in 2026. But if you have a fixed rate loan, you are fine. Your rate is locked. This does not affect you until renewal. For savers, there is a small silver lining. When BNR raises rates, deposit rates at banks tend to follow, eventually. Right now, the average deposit rate is 8.98%, which barely matches inflation. With the CBR now at 7.25%, there is pressure for deposit rates to move up over the coming months. That could push returns above inflation, giving savers a positive real return for the first time in a while. But do not expect overnight changes. It takes time. And if you are still in a basic savings account earning 2 to 3%, a rate hike does not help you. You need to actively move your money to where it earns more. Here is what to do right now. 1. If you have a variable rate loan, check with your bank whether your rate will change. Ask when and by how much. Do not be surprised. 2. If you are saving in a basic account, call your bank and ask about their fixed deposit rates. Compare at least 3 options. Even 1% more matters. 3. Tighten your budget for the next 6 months. BNR expects inflation to stay above 8% through the first half of 2026. Use the 70-10-20 budget method from our first video to make every franc count. If you want to understand inflation from the ground up, what it is, how it works, and how NISR measures it, watch our full explainer video right here. And subscribe for CPI Watch, our monthly breakdown every time new data drops. Thanks for watching Africa Money.